As China's economic woes continue to worsen, the authorities, seemingly powerless to address the issues, have taken an unprecedented step to silence online critics, forbidding any negative discussions on the economy. The Chinese Ministry of State Security has declared criticizing the economy a national security issue, prompting public mockery and raising concerns that foreign investments might flee even faster. On December 15th, the Ministry of State Security released an article on its WeChat public account titled, "Building a Resilient Economic Security Barrier for National Security." The article claims that economic security is a crucial component of national security. It summarizes criticisms labeled as slandering China's economy, including accusations of replacing development with security, excluding foreign investments, and suppressing private enterprises. The piece elevates criticizing the economy to a national security issue and threatens to crack down on those with ulterior motives. Simultaneously, some Chinese internet influencers appear to have received notices from authorities. Screenshots circulating online indicate that on December 14th, Weibo Finance and Weibo Stocks notified influencers to pay attention to the tone of their speech in recent posts and refrain from making any negative remarks about the economy. Weibo Legal also issued a group notice warning that the handling of criticisms of the economy would be severe, urging users not to cross the red line. Some well-known figures have been directly silenced, such as Liu Jipeng, an expert on China's joint stock companies and director of the Capital and Finance Research Institute at China University of Political Science and Law, who has been banned from speaking and following on platforms like Douyin, Weibo, and Toutiao since December 7th, and his Weibo account has disappeared. On December 17th, commentator Zhou Xiaohui wrote in Epoch Times that the Ministry of State Security elevating criticizing the economy to a national security issue and issuing threats on financial and economic matters reflect two major problems. It indicates that China's economy is in dire straits, and the Chinese Communist Party is helpless, resorting to censorship. As netizens commented, this is tantamount to official recognition that China's economy is beyond salvation. On the other hand, it highlights that the CCP leader is paranoid about security issues, openly using national security forces to intimidate those against Xi Jinping, serving as a glaring example of the party's insecurity. Economic downward spiral. Xi Jinping's visit to Shanghai coincides with A-share plummet. It was just last week when Xi Jinping visited Shanghai for 3 days, inspecting the futures exchange and various technology centers. Liu Baoji, the host of Taiwan's TV program Critical Moment, mentioned that Xi Jinping is deeply concerned about Shanghai's economy and, by extension, China's overall economic situation. His visit aimed to boost the country's economic development. However, unexpectedly, the Shanghai Stock Exchange did not cooperate. Instead of rising, the market took a nosedive, plummeting below 3,000 points in a fierce battle for survival. Xi Jinping, hoping to uplift China's economic prospects, faced a surprising setback as the Shanghai Stock Exchange demonstrated a lack of cooperation. Rather than witnessing growth, the market exhibited a frenzy of decline. Currently, Shanghai's stock market is in a freefall, dropping over 1,000 points and facing a critical struggle. This unexpected turn of events in Shanghai's stock market prompts a broader concern. The impact is not limited to Shanghai alone. It is now affecting Hong Kong as well. Observers note a significant development. The stock markets in Taipei and Hong Kong are showing signs of a golden cross, which already occurred last week. However, the discrepancy between the two is widening, with Hong Kong's market hovering around 16,327, while Taipei's has surged to 11,728. This growing gap suggests that the divergence between the two markets will continue to widen. The global business media is echoing the sentiment that China is caught in a frightening economic downward spiral. All indicators are showing an unlimited decline, contributing to an alarming and vicious cycle. Endless plunge in A-share market. Hu Xijin's stock trading records, over 40,000 yuan in losses in 6 months. Hu Xijin, who boldly entered the A-share market in June this year, has faced a continuous string of losses in his stock trading venture. Initially allocating 100,000 yuan to his account, he later declared additional investments. In September, during a live broadcast, he expressed his aspiration to be a bull like Warren Buffett, and even mentioned hoping to earn enough for a premium school district property in Shanghai. However, starting in October, Hu Xijin's stock trading endeavors descended into a pit of persistent losses. On October 18th, he posted on his Weibo account revealing that his total floating losses had surpassed 30,000 yuan for the first time. By October 23rd, his losses exceeded 40,000 yuan, and now the figure stands at 42,000 yuan. Commenting on Hu Xijin's stock trading journey, commentator Qiu Lin published an article on November 17th titled "Hu Xijin has no destiny in stock trading, yet has contracted the disease," stating that Hu Xijin's recent blog posts revealed emotions of disappointment and anxiety, expressing concerns about future trends. The article notes that, although Hu Xijin initially gained over 10,000 yuan in personal account profits after entering the market, as the stock market continued to weaken, his stock account losses expanded. Hu Xijin, who once fervently advocated faithful investment, shifted to urging against, allowing the stock market to continue its downward spiral. China's economy exposed, resembling the Soviet Union in the 1970s. China's economy has recently revealed a series of troubling data points, reminiscent of the Soviet Union in the 1970s. With multiple sectors issuing a flurry of documents, is there any way to reverse the situation? Professor Su Chenggang, a renowned scholar specializing in the long-term study of the Chinese economy, believes that this is a systemic issue that has been exposed. Mechanisms that once facilitated China's rapid economic development have one by one been lost, leading to a long-term slowdown in China's economic growth, akin to the Soviet Union in the post-1970s era. Another wealth management giant in China faces collapse. Xi'an clients rally for rights protection. On December 17, 2023, the Shanghai-based wealth management firm Xi'an was hit by news of a potential collapse, leading numerous investors to rally for their rights at the company's headquarters. Despite negotiations between the company's management and investors, share prices continued to plummet. This incident is considered another seismic event in the Chinese financial market following the China Evergrande Group crisis. On December 14th, Xi'an Wealth, self-proclaimed as China's third-largest third-party wealth management service provider, announced on Nasdaq that the wealth management products it distributed faced redemption issues, with the management unable to reach agreements on deferred payments with the concerned clients. According to reports, at the close of the U.S. stock market on December 15th, Xi'an Holdings witnessed a nearly 16% plunge, closing at $2.77 per share, resulting in a market capitalization reduction to $77.66 million, making it one of the Chinese concept stocks with the largest decline that day. Compared to the previous day's closing price, the market capitalization shrunk by over $14 million overnight. In reality, Xi'an Holdings stock had been in a downward spiral since December 8th. Calculated from the closing price of $6.65 on December 7th, the stock experienced an accumulated decline of 58.3% in the past 5 trading days. On the 15th, multiple videos circulated online, showing a large number of investors rushing to the headquarters of Xi'an Wealth to safeguard their rights. Xi'an chairman Han Hongwei met with the investors, pledging not to let financial advisors and clients suffer losses, but stating that it would take time to step-by-step resolve the issues. When someone asked, "How long will it take approximately?" Han responded, "I will let you know, but I cannot answer that right now." The Beijing property market is experiencing a precipitous decline with 170,000 second-hand homes listed for sale as China's economic outlook dims. The plunging prices make it challenging to close deals, even with buyers negotiating discounts of up to 1 million yuan on properties priced in the millions. Experts predict that Beijing's property prices will continue to decline. Beijing livestream host I Am Who I Am. More than 90% of houses in Beijing are declining. Beijing livestream host Xi'an talks real estate. Do you know how crazy the Beijing property market has become? In Beijing, you must not randomly buy houses. In recent times, many mainland livestream hosts have revealed a drastic decline in the prices of second-hand homes in Beijing, with numerous properties facing difficulty in selling even after substantial price reductions. According to Xi'an Talks Real Estate, one of the hosts listed a property for sale around mid-August with an initial asking price of about 9.5 million yuan, but recently reduced it to 8.3 million yuan without finding a buyer. Another live stream host mentioned that a neighbor's property has been listed for sale for 3 years but still hasn't been sold. The Chinese National Bureau of Statistics has been accused of falsification as it claims to be refining the methodology for calculating youth unemployment rates. On December 15th, the NBS released data stating that the urban surveyed unemployment rate in China for November was 5%, adding that they are currently perfecting the relevant methods and systems for youth unemployment rate and will release it in a timely manner once the related statistical work is further improved. In July of this year, the NBS reported a youth unemployment rate as high as 21.3%, but starting from August, the official agency ceased disclosing youth unemployment rates. There are suspicions that the youth unemployment situation in China has become so severe that the Communist Party finds it challenging to disclose accurate figures. Wang Gang, an associate professor at a Chinese university, expressed to the new Tang dynasty that the government's data on employment for university graduates is fabricated and not trustworthy. He explained that the government pressures universities, and in turn, universities pressure teachers to manipulate employment data to present a more favorable picture of the job market for graduates. Professor Xu Chenggang of Stanford University's China Economic Research Center told Radio Free Asia that the official discontinuation of reporting youth unemployment rates is due to contradictions with the economic growth data. While official figures suggest a 20% youth unemployment rate, independent economists within the country estimate it to be as high as 40%. It seems illogical for the economy to be growing positively in the face of high unemployment rates. An era in China has come to an end, and Xi Jinping's prioritization of political struggles has damaged the economy. Current affairs commentator Wu Zijia states that due to the Communist Party's approach to governing the country, there is a regression to ancient times under Xi Jinping, returning to the traditional concept of the Communist Party, putting political struggles first and economic development second. Xi Jinping is quite unique in that he lacks a clearly defined economic policy. Currently, all foreign businesses have left, and exports have also declined.